If you've spent years mastering the majors like EUR, USD, or GBP, JPY, the high alpha potential of the BTC USD ticker is incredibly tempting. You already have a technical edge. The question is whether it translates to crypto. Most traders assume it does. They load up their standard 1.00 lot size and set the same 20 pip stop loss that has served them well on fiat for a decade. This comparison shows why that strategy fails. On the left, the euro's movement is contained, but on the right, Bitcoin produces a violent downward wick that instantly spikes through a tight stop loss. The position is liquidated before the trend even begins. This happens because Bitcoin isn't a traditional currency. It functions as a hybrid between a high-growth tech stock and a monetary commodity, which gives its price action an entirely different personality. Applying fiat-based risk management to this asset assumes a level of price stability Bitcoin rarely respects. This mismatch between trade structure and price movement is the primary reason standard Forex strategies often result in unintended account risk. To trade this asset effectively, you can use a contract for difference, or CFD, on FXNX. This approach provides access to leverage, which is the first major mechanical shift from spot exchanges. With leverage ratios between 1 to 5 and 1 to 20, you can control a $60,000 asset without locking up your entire capital reserves. This environment also allows for seamless shorting. If you believe the crypto market is overextended, you can hit the sell button instantly, avoiding complex borrowing processes required on native crypto exchanges. The result is unified capital. You can trade a gold breakout in the morning and pivot to a Bitcoin trend in the afternoon, managing both positions from a single margin account. Success starts with a shift in mathematics. While the euro rarely moves 100 pips in a single day, Bitcoin can swing $1,000, or points, in just 10 minutes. This diagram illustrates the scale difference between a single euro pip and a Bitcoin point. On most Forex platforms, one full lot of BTC/USD is defined as one whole Bitcoin. You must verify this with your broker. Some use mini lots, where one lot equals only a tenth of a Bitcoin. Checking the contract specification window is a mandatory step before your first execution. Most traditional traders blow up their accounts because they skip this calculation. They enter the market with a lot size that is far too large for the asset's nominal value. To survive Bitcoin's volatility, you must discard fixed pip counts. Instead, use the daily average true range, or ATR, to determine your trade size. This panel shows a standard risk management setup. On a $10,000 account, we want to risk exactly 1%, which is $100. We are entering the market at $65,000. Next, we look at the ATR. If the indicator shows a daily range of $3,000, we place our stop loss at least $1,500 away, at $63,500. This creates a survival zone, protecting you from daily market noise. Now we find our position size. By dividing our $100 risk by the $1,500 stop distance, the math gives us exactly 0.06 lots. With this calculation, Bitcoin can drop $1,500, hitting your entire stop loss, and your total portfolio loss remains capped at exactly 1%. You also need to account for a structural timing gap. Forex brokers close their servers on Friday evening, but global crypto exchanges trade 24 hours a day, 7 days a week. This creates price gaps. If a major event occurs over the weekend, the global price continues to move while your broker is offline, resulting in a sudden jump or drop upon the Sunday reopening. Many traders use a gap fill strategy for this. If the market opens with a significant gap on Sunday, they look for bearish price action on the 15-minute chart to trade the move back down to Friday's closing price. There is also a common myth that Bitcoin is digital gold. Traditionally, gold bars are viewed as a stable, safe haven asset that rises when other markets panic. However, look at the Nasdaq. In reality, Bitcoin currently behaves as a high beta risk asset. It moves in close correlation with tech stocks and is highly sensitive to changes in interest rates. This is why checking the Nasdaq 100 is mandatory. If tech equities are breaking a major support level, you should be very cautious about taking a long position on Bitcoin, regardless of what the individual BTC chart looks like. Trading Bitcoin and Forex is about more than just a new ticker. It requires moving from the grinding trends of central banks to the speculative volatility of a tech-driven asset. Your next step is to load the BTC/USD pair on a demo account. practice the 1% ATR sizing formula until the math becomes second nature, and the volatility no longer disrupts your psychology. Using an NX1 account provides the institutional-grade technology to execute this correctly, with 0.0 pip spreads and access to over 500 different instruments. By respecting the scale of the market and adjusting your math, you can transform Bitcoin's famous volatility into the most rewarding instrument in your portfolio.